Ever felt like direct tax laws are a dense jungle, especially when it comes to something as intricate as capital gains? You are definitely not alone in that feeling. It often feels like you need a special decoder ring just to understand the basics, let alone the nuances that can trip you up. But what if there was a way to not just navigate it, but truly master it, grasping every detail and exception as if you were prepping for the toughest exam? Today, that's precisely our mission. We are diving deep into the intricate world of capital gains under India's direct tax laws. This isn't just about skimming the surface, it's about getting down into the specific sections, understanding the crucial exceptions, cracking the calculation logic, and identifying those real world implications that can make or break an application based scenario for you.
That's right. Our goal today is to equip you with an absolutely exam-ready understanding. We'll meticulously break down the source material, ensuring we cover every single concept and detail strictly in the sequence provided. Think of this as your shortcut to comprehensive mastery, designed to give you those crucial aha moments that make complex rules stick. We'll explore not just the what of the law, but also the why behind it, helping you connect the dots so you're not just informed, but truly well prepared to tackle any question thrown your way, no matter how tricky.
All right, let's unpack this. Our starting point, the foundational piece, is Section 45. This is what we call the charging section. It's the very heart of capital gains taxation. It lays down the core principle. Any profits or gains that arise from the transfer of a capital asset in the previous year are chargeable to income tax under the head capital gains. It sounds straightforward enough, but as we always say, the devil is in the details, especially for an exam. It absolutely is. And for your exam, that precise timing is vital. These gains are critically deemed to be the income of the previous year in which the transfer actually took place. Not when the agreement was signed, but when the legal transfer happened. Throughout this deep dive, we're going to zero in on two absolutely vital terms highlighted right here in Section 45: capital asset and transfer. Our roadmap for today will start by defining these two terms in detail. Then we'll move on to discuss the various circumstances under which capital gains tax is levied, including a crucial segment on transactions that are not regarded as a transfer for tax purposes. Okay.
We'll also cover special methods for depreciable assets. And finally, look at exemptions for investments in specified assets that could potentially save you significant tax.
So let's kick off with the first critical definition. What exactly constitutes a capital asset? Section 214 gives us the legal answer. At its broadest, a capital asset means property of any kind held by an assessee, whether or not connected with his business or profession. That's an incredibly wide-ranging definition, encompassing almost anything you might own. But are there specific additions or exclusions we should be aware of?
It is indeed a very broad definition designed to capture most forms of property. But it also explicitly includes some very specific items that are worth noting, and these can be test-worthy details. For instance, any securities held by a foreign institutional investor, FII, that invests according to the regulations set by the Securities and Exchange Board of India, SEBI, are considered capital assets. Also, certain unit-linked insurance policies, ULIPs, issued on or after February 1st, 2021, are now classified as capital assets. This applies specifically if they don't qualify for exemption under Section 1010D due to two important conditions, known as the fourth and fifth provisos.
And those ULIP conditions are a good example of the kind of nuance that can catch you off guard, aren't they? How does a ULIP actually become a capital asset?
It's all about the premium. A ULP becomes a capital asset if its premium payable exceeds $2,050,000 for any single previous year during its term. That's the fourth proviso to Section 1010D. But there's a further layer of complexity for those holding multiple policies. If someone has multiple ULPs, all issued on or after February 1st, 2021, and their aggregate premium across all these policies exceeds $2,050,000 for any previous year, they actually get to choose which specific ULPs will receive the Section 10D exemption up to that $2,050,000 aggregate limit.
Ah, okay. So they have a choice.
Exactly. All other ULPs they hold that fall outside this chosen exemption then become capital assets.
Yeah.
This is per the fifth proviso, and it's a detail that often comes up in application questions.
So while the definition of a capital asset is broad, it seems equally important to know what isn't a capital asset. What are these crucial exclusions?
You're absolutely right. These exclusions are just as vital as the inclusions, especially for your exam. The definition does not include several key categories. First, stock in trade. This covers consumable stores or raw materials held for business or profession. The only exception here, and it's an important one, is those FII securities we just mentioned.
Which are always capital assets.
Exactly. Always capital assets, even if held as stock in trade. The regulations emphasize that whether something is stock in trade or a capital asset truly depends on how you hold it and your intent, not its inherent nature. For example, a property dealer holds land as stock in trade, but for an investor, that exact same land is a capital asset. Also, the Finance No. 2 Bill 2014 clarified that profit from a foreign portfolio investor (FPI) security transfer is a capital gain, regardless of whether a fund manager is present in India.
Okay, so intent matters. What's next?
Second, personal effects. This generally refers to movable property used for personal purposes by you or your dependent family members, including things like wearing apparel and furniture. However, and this is a key detail, certain items are specifically excluded from this personal effects exclusion, meaning they are indeed capital assets.
Like jewelry.
Precisely. This list includes jewelry, archaeological collections, drawings, paintings, sculptures, and any work of art. So if you sell a painting, even if it's been hanging in your living room for years, it's treated as a capital asset.
Got it. What else is excluded?
Third, rural agricultural land in India. This refers to land not situated in any specified urban area. The critical implication here: urban agricultural lands are capital assets, and their transfer does attract capital gains tax. Explanation 1 to Section 2(1)(a) clarifies that gains from urban agricultural land are not agricultural income and are therefore taxable under Section 45.
Okay, so urban agricultural land is in, rural is out. Anything else? Yes. Finally, the definition also excludes certain specified gold bonds, like 6.5% gold bonds 1977, 7% gold bonds 1980, National Defense Gold Bonds 1980, Special Bearer Bonds 1991, and gold deposit bonds or deposit certificates issued under various gold deposit or monetization schemes. An important concluding note on the definition of property for capital gains purposes. It includes and shall be deemed to have always included any rights in or in relation to an Indian company, including rights of management or control or any other rights whatsoever.
Wow, that broadens the scope quite a bit.
It does. It extends the reach of capital asset beyond tangible property to encompass valuable intangible rights.
That distinction between short-term and long-term capital assets is absolutely fundamental because it directly affects how your gains are taxed. Generally, a short-term capital asset, or STCA, is something held for not more than 36 months, immediately preceding its transfer. Anything held for longer then becomes a long-term capital asset, or LTCA.
This is where the dates become absolutely critical, especially with recent significant changes. Effectively, from July 23, 2024, the general holding period for an STCA has been substantially reduced to not more than 24 months.
24 months, that's a big shift.
It is a monumental shift that you need to be acutely aware of for any application questions. Let's quickly go through the holding period rules, keeping in mind the before and on or after July 23, 2024 scenarios. If a transfer took place before July 23, 2024, for assets held for 12 months or less, they were STCG. More than 12 months, LTCG. This category included securities listed on a recognized stock exchange, excluding units, units of an equity-oriented fund or UTI, and zero-coupon bonds.
Okay, the 12-month rule for listed securities and funds.
Right. Then for assets held for 24 months or less, they were STCG. More than 24 months, LTCG. This covered unlisted shares and land or building, or both.
Unlisted shares and property at 24 months.
Correct. And for anything held for 36 months or less, they were STCG. More than 36 months, LTCG. This broadly applied to listed units of a business trust, unlisted securities other than shares, and the general category of other capital assets.
So that was the old 36-month catch-all.
Pretty much. Now, for transfers taking place on or after July 23, 2024, the rules are somewhat simplified, reflecting the overall reduction in the general holding period. Assets held for 12 months or less are still STCG, more than 12 months, LTCG. This applies to securities listed on a recognized stock exchange, now including listed units of a business trust, units of an equity-oriented fund or UTI, and zero-coupon bonds.
So the 12-month rule stays for listed stuff.
Yes. However, for other capital assets, the new general rule is 24 months or less for STCG and more than 24 months for LTCG.
Ah, so the general rule dropped from 36 to 24 months?
Exactly. This category now encompasses most assets not covered by the 12-month rule, representing a significant change for property and unlisted shares.
So even with those general rules, are there any assets that are always considered short-term, regardless of how long you hold them?
Yes, there are, and Section 50AA is absolutely key here. Regardless of the holding period, capital gains from the transfer of these specific assets are always treated as short-term capital gains, and this rule overrides the general definitions. Units of a specified mutual fund acquired on or after April 1st, 2023.
Okay, those debt funds.
Market link debentures,
MLDs, right?
and a very specific and recent addition, unlisted bonds and unlisted debentures that are transferred or redeemed or mature on or after July 23, 2024. This ensures they are consistently treated as short-term with no indexation benefit.
That's a crucial point. No indexation for those.
None at all. When we refer to an equity-oriented fund, it's specifically defined as a fund where a minimum of 65% of its total proceeds.
Or 90% if it's a fund or funds structure.
Exactly. Or 90% if it invests in another fund that then invests 90%, is invested in equity shares of domestic companies listed on a recognized stock exchange. For EULA piece, this 65% or 90% rule must be satisfied throughout the policy term, which is an important ongoing condition.
That's a lot of detail, but super useful for navigating these categories. What about fixed maturity plans, or FMPs? If you're invested in an FMP and you opt to roll over its duration, does that immediately count as a transfer and trigger capital gains tax?
That's an excellent practical question, and CBDT Circular No. 6/2015 provides crucial clarity here. According to the CBDT, if you choose to roll over the duration of an FMP, this action does not count as a transfer for tax purposes.
Oh, that's good news for investors.
It is. Capital gains only arise when you actually redeem the units or completely opt out of the scheme. This is a very beneficial clarification for taxpayers, as it avoids premature tax liability for what is essentially a continuation of the investment.
The definition of holding period isn't always straightforward. Sometimes it includes the period an asset was held by a previous owner, or even in a different form. Can you walk us through some of these important scenarios that often come up in application questions?
Absolutely. These specific inclusions in Section 242A explanations are vital for accurate calculation. The law recognizes that a transfer isn't always a clean, new acquisition. Here are some key instances where a previous holding period is considered. Shares received in amalgamation. You include the holding period in the amalgamating company.
Okay, makes sense.
Shares or securities subscribed based on a right or renunciation. The holding period starts from the date of allotment. Right to subscribe renounced. The period is reckoned from the day the offer of such right was made.
From the offer date, right.
Financial asset allotted without payment based on other holding. The holding period starts from the date of allotment. Shares in a resulting company due to a demerger. You include the holding period in the demerged company.
Tacking on the old period.
Exactly. Trading or clearing rights acquired from demutualization of a stock exchange. The holding period of the original shares is included. Units in a consolidated mutual fund scheme. The holding period in the consolidating scheme is included.
Okay.
Shares acquired on Global Depository Receipt, GDR, redemption. The period is reckoned from the date the redemption request was made. Equity shares from preference share conversion. You include the holding period of the preference shares.
Right, for converted shares.
Units in a consolidated plan of a mutual fund scheme. The holding period in the consolidating plan is included. Units in a segregated portfolio. The period for which the original units in the main portfolio were held is also reckoned.
So the side pocket units inherit the original holding period.
Correct. Electronic gold receipt, EGR conversion. If gold is converted to an EGR, you include the holding period of the gold before conversion. If an EGR is converted back to gold, you include the holding period of the EGR before conversion.
Seamless transition there.
Specified security or sweat equity shares allotted to employees. The holding period starts from the date of allotment or transfer. Capital asset from foreign company branch conversion. The period held by the foreign company branch and any previous owners is included. Finally, for income chargeable under Section 45(4), which relates to firm AOP BOI reconstitution. This is a complex one. The classification as STCG or LTCG depends entirely on whether the attributed capital asset is a short-term capital asset, part of a block of assets, a self-generated asset, or a long-term capital asset at the specific time the income is taxed.
That sounds like a potential exam trap.
It absolutely can be. That attribution and timing under 45(4) is critical for advanced application questions.
With all those nuances of what a capital asset is and how long it's held, let's move on to the second critical term, transfer. In tax law, the term transfer is much broader than just a simple sale. It's an inclusive definition, meaning it covers a range of transactions beyond the obvious handshake deal.
That's a crucial point. For capital gains purposes, transfer includes the straightforward actions like a sale, an exchange, the relinquishment of an asset, the extinguishment of any rights in it, and compulsory acquisition under any law. But the Act also specifically deems certain other transactions as transfer for capital gains, ensuring they don't slip through the cracks. This includes the maturity or redemption of a zero-coupon bond.
Okay, CCBs.
Another key deemed transfer is giving possession of an immovable property in consideration of part performance of a contract, as referred to in Section 53A of the Transfer of Property Act. For example, if you sell a house, receive full payment, and hand over possession to the buyer, even if the formal registration deed isn't executed yet.
That's a transfer for tax purposes.
Exactly. For income tax purposes, that's already considered a transfer. It also covers transactions that have the effect of transferring or enabling the enjoyment of an immovable property. To illustrate, if you become a member of a cooperative society that constructs flats, pay the agreed amount, and gain possession of a flat, even without a formal conveyance deed being executed immediately, this transaction is considered a transfer for capital gains.
And it sounds like explanation 2 to Section 247 really drives this home, doesn't it? That transfer includes and shall be deemed to have always included these types of transactions.
Precisely. That phrasing reinforces that these transactions have always been intended to fall into the law's scope, ensuring no ambiguity for tax purposes. Now, let's talk about the scope and year of chargeability under Section 45. The general provision, Section 45(1), states that capital gains are taxable in the previous year in which the transfer took place. A significant point here, stemming from the Alapati Venkataramaya VCIT case, is that the relevant date is the actual date of sale, when the transfer of title legally happens, not just the date of an agreement to sell.
That's a subtle but vital distinction.
It can be, yes. It determines which financial year the tax falls into.
What if a capital asset is damaged or destroyed, say, by fire, explosion, or enemy action, and you receive money or assets from an insurer? When are those profits taxable as capital gains, if at all, under Section 45(1)(a)?
Under Section 45(1)(a), the crucial part is when it's taxable. It's deemed income of the previous year in which the money or other asset was received.
So the receipt triggers the tax.
Exactly. It's the receipt that triggers the tax, not the damage itself. The full value of consideration for computing capital gains in this scenario will be the money received or the fair market value of the assets received on that specific date.
And for those unit-linked insurance policy or UIPOP receipts under Section 45(1)(b, specifically, for those policies issued on or after February 1st, 2021 that don't qualify for Section 1010D exemption due to high premiums, how is any amount received, including bonuses, charged to capital gains tax?
This income is deemed to be of the previous year in which the amount was received. Rule 8AD provides a specific computation method for this, which is important for your calculations. For the first-time receipt, you calculate it as the amount received plus bonus minus aggregate premium paid till the date of receipt.
Okay.
For subsequent receipts, it's the amount received plus bonus minus aggregate premium paid till the current receipt date, reduced by any premium already considered in earlier calculations. The capital gains computed this way are deemed to arise from the transfer of a unit of an equity-oriented fund set up under an insurance company scheme.
Now let's talk about Section 45(2), converting a capital asset into stock and trade. If you as the owner convert a capital asset you own into stock and trade for your business, this conversion is considered a transfer, right?
That's correct. It is a deemed transfer. However, and this is a key timing point, the profits or gains from this deemed transfer are chargeable to income tax only in the previous year when that stock and trade is actually sold or transferred to an outsider.
Ah, so taxed on sale, not conversion.
Exactly. The full value of consideration for calculating the capital gain in this scenario is the fair market value of the asset on the specific date of its conversion. This means you might convert it in 1 year, but pay tax on the capital gain in a later year when you actually sell it as stock in trade. For computation, the capital gains calculation allows indexation benefit up to the year of conversion.
Okay. Indexation up to conversion.
Right. Any further gain realized from the fair market value on conversion to the eventual sale price is then treated separately as business income. This scenario perfectly illustrates the interplay of capital gains and business income.
Interesting. So the capital gain happens on conversion but is taxed on sale, and any further gain is business income. How about Section 45(2)(a) for beneficial interest in securities?
Briefly, Section 45(2)(a) deals with the transfer of beneficial interest in securities. For sale transactions, the broker's note date is generally treated as the date of transfer, provided it's followed by delivery and transfer deeds. For purchasers, the holding period starts directly between the parties, not through exchanges. This is explicitly laid out in CBDT Circular number 704.
All right, let's unpack this next one. Section 45(3).
If you transfer a capital asset to a firm, an association of persons, AOP, or a body of individuals, BOI, where you're already a partner or member or are becoming one as capital contribution, that's considered a transfer, right?
Yes, that's absolutely correct. It is considered a transfer. The profits or gains from this transfer are taxable in the previous year of transfer. For this specific scenario, the full value of consideration is deemed to be the amount recorded in the books of account of the firm, AOP, or BOI, as the value of that capital asset.
The book value, not necessarily market value.
Exactly. This is a critical detail. It's not necessarily the market value outside, but what's officially recorded in their books.
Now we're diving into a genuinely complex but crucial area. The tax implications when a partner or member receives money or a capital asset from a firm, AOP or BOI, upon its dissolution or reconstitution. This is governed by two interconnected sections, Section 9b and Section 45.4, and they often trip up even experienced professionals.
You're right. This is where it gets really interesting and complex for exams. Let's break it down, starting with Section 9b, which deals with a deemed transfer by the entity. The core idea is that if a specified person, meaning a partner of a firm or a member of an AOP or BOI, receives any capital asset or stock in trade from a specified entity, the firm, AOP or POI, in connection with its dissolution or reconstitution, then the entity itself is deemed to have transferred that asset or stock.
So the tax liability falls on the entity, not the individual receiving the asset. And when does that profit or gain actually become income for the entity?
Precisely. Any profits and gains from this deemed transfer, whether it's a capital asset or stock in trade, are deemed to be the income of the entity in the previous year in which the asset or stock was actually received by the specified person. If it's a capital asset, it's taxed under capital gains. If it's stock in trade, it's taxed under profits and gains from business or profession. The full value of consideration for this deemed transfer is critically the fair market value, FMV, of the asset or stock in trade on the date it's received by the specified person.
Okay, FMV on date of receipt.
This ensures the entity pays tax on its market value. Now let's move to Section 45.4, which handles deemed income in the entities specifically on reconstitution. This applies where a specified person receives money or a capital asset or both from a specified entity in connection with its reconstitution. Any profits or gains arising from this receipt are chargeable as capital gains in the entity's hands, taxable in the previous year of receipt. The key insight here is that this section captures any untaxed gains released to partners, especially those arising from revaluation of assets.
And there's a specific formula for calculating this income under 45.4, isn't there? It's not just a straightforward market value, which adds another layer of complexity.
That's right. The calculation under Section 45.4 uses a formula.
Yeah.
A equals B plus CD. A is the income chargeable under Section 45.4. B is the value of any money received by the specified person on the date of receipt. C is the fair market value of the capital asset received by the specified person on the date of receipt. And D is the balance in the capital account of the specified person in the entity's books at the time of reconstitution.
Okay, but without revaluation effects.
Critically, yes. This D value is calculated without taking into account any increase in the capital account due to revaluation of any asset, or the recognition of self-generated goodwill or any other self-generated asset. A self-generated goodwill or self-generated asset is defined as goodwill or an asset acquired without incurring any purchase cost or generated during the course of the business or profession. A key point for exam purposes: if the value of A in the formula turns out to be negative, its value is simply deemed to be zero.
Right, prevents a loss.
This prevents a loss from being recorded.
So if a partner receives a capital asset from a firm on reconstitution, it seems like both Section 9b and Section 45.4 could potentially apply. How do they interact? Do they overlap or are they distinct?
This is a crucial distinction and a common point of confusion. When a capital asset is received by a specified person from an entity on reconstitution, both Section 9b and Section 45.4 apply in addition to each other.
Both apply simultaneously.
Yes, they operate independently. Section 9b taxes the entity on the transfer of the specific asset at FMV, while Section 45.4 captures any broader gain attributed to the increase in the partner's capital account not already taxed, often from revaluations. However, if a specified person receives money on reconstitution, that's covered only by Section 45.4. And if they receive stock in trade on reconstitution, that's covered only by Section 9b.
Okay, that clarifies the scope.
This clearly delineates their respective scopes. To clarify definitions for these sections, a specified person is a partner of a firm or a member of AOPs or BOIs, but not a company or a cooperative society. A specified entity is a firm or other AOPs or BOIs, again, not a company or a cooperative society. Reconstitution occurs when one or more partners or members cease to be so, or new ones are admitted while some old ones continue, or all partners members continue with a change in their respective shares.
And dissolution isn't covered by 45
Uh,
4.
Right. It's important to note that the outright dissolution of a specified entity, which is covered solely under 9b, is not covered under 45.4.
Hmm.
Now, regarding the type of capital gain under 45.4, whether it's short-term or long-term, Rule 8AA5 clarifies this. The income under 45.4 is deemed to be a short-term capital gain if it's attributed to a short-term capital asset, an asset forming part of a block of assets, or a self-generated asset or goodwill. It's a long-term capital gain if attributed to any other long-term capital asset.
How exactly is the income from 45.4 linked to specific assets? Is there a process for attributing it, and what's the purpose of that attribution?
Yes. Rule 8AB, further clarified by CBDT Circular 1.2021, provides this attribution mechanism. If the excess amount, which is the money plus FMV of asset received minus the capital account balance from the 45.4 formula, relates to a revaluation of capital assets or valuation of self-generated assets or goodwill based on a registered valuer's report, then the 45.4 amount is attributed proportionally to the increase in value of each relevant asset.
Okay, based on the increase in value.
The formula for attribution is amount charged us, 45.4, increase in value of that asset due to revaluation valuation. Aggregate increase in value of all assets due to revaluation valuation.
What if the excess amount doesn't relate to revaluation or self-generated assets or goodwill, or if it relates only to the capital asset received by the specified person?
In those specific cases, the amount charged to tax under Section 45.4 is not attributed to any capital asset.
So it just stays a general capital gain.
Exactly. It just remains a lump sum capital gain without a direct link to any specific asset for future adjustment purposes. The specified entity must also furnish these attribution details in Form Number 5C by the income tax return due date. It's crucial to understand that revaluation or recognition of self-generated assets or goodwill does not entitle the entity to depreciation on that increased value.
No depreciation on the revalued part.
Right, which is a common misconception. And a clarification from CBDT Circular Number 14/2021 states that Rule 8AB also applies to capital assets forming part of a block of assets. If an amount is attributed to a block asset, it's reduced from the full value of consideration on subsequent transfer of that specific asset, impacting its written down value for depreciation. Let's illustrate the powerful interplay of Sections 9b and 45.4 with a simplified example focusing on the concepts. Imagine a firm where partner A exits. The firm revalues its assets, and A receives some money and a capital asset. First, the 9b layer. The firm is immediately taxed on the fair market value of the specific capital asset it gives to partner A.
Okay, tax on the asset given out.
This ensures that the firm pays tax on the market gain of that asset, just as if it sold it. Second, the 45.4. Separately, the firm is also taxed on any amount A receives, money plus the FMV of the asset, that exceeds A's capital account balance before any revaluations.
The excess over the original capital account.
Exactly. This second layer essentially taxes the firm on any hidden or revalued gains that increased A's capital, ensuring a comprehensive tax capture. Third, the attribution. If this additional 45 gain comes from revalued assets remaining in the firm, that gain is then attributed to those remaining assets. This attributed amount will reduce the sale consideration of those assets when the firm eventually sells them, preventing double taxation of the same gain.
So it adjusts future calculations.
Precisely. And fourth, the biggest pitfall. For taxpayers, the biggest pitfall here is missing that second layer of tax under Section 45.4, which applies even if no specific capital asset is distributed beyond money, or if assets were distributed but also revalued. It's a clever, two-layered safeguard to prevent tax avoidance.
That's incredibly detailed and clarifies a lot about those tricky sections. What about compensation received when a capital asset is compulsorily acquired by the government under Section 45?
In such cases, the capital gains are taxable in the previous year in which the compensation or any part thereof was first received.
Again, date of receipt is key.
Exactly. So again, it's the date of receipt that triggers the tax liability, not the date of acquisition itself. The compensation amount itself, or the fair market value of any other assets received, is considered the full value of consideration for this purpose.
And Section 45.5a addresses a very common and previously difficult issue for individuals and Hindu undivided families, HUFs, who give their land or building to a developer for a project. Previously, the transfer technically occurred when possession was handed over, leading to tax liability before the actual consideration of the constructed property was received. This created a genuine hardship. How does 45A provide relief?
This section provides significant and very practical relief. For an individual or HUF who enters into a specified agreement for project development, the capital gain is chargeable only in the previous year when the certificate of completion for the project, either in whole or in part, is issued by the competent authority.
Tax deferred until completion certificate.
That's the essence. A specified agreement here means a registered agreement where a land or building owner allows development in exchange for a share in the project, typically land or building units, possibly with some cash consideration. The competent authority is the authority approving the building plan, and stamp duty value refers to the value for stamp duty purposes. The core idea is that tax is deferred until the project reaches a tangible stage of completion, aligning the tax event with the receipt of actual value.
But what if they sell their share early?
That's crucial. It's crucial for you to understand the condition. If the individual or HUF transfers their share on the project prematurely, before the completion certificate is issued, then this deferment doesn't apply, and the tax liability arises immediately when the original property was handed over to the developer.
Let's shift gears to Section 46, dealing with capital gains on company liquidation. When a company distributes assets to its shareholders upon its liquidation, this specific distribution is not regarded as a transfer by the company for Section 45 purposes. So the company itself doesn't incur capital gains tax on this direct distribution, correct?
That's right. Section 46(1) provides that specific exemption for the company. However, there's a crucial caveat for exam purposes. If the liquidator sells the company's assets first, which generates a capital gain for the company, and then distributes the funds.
Then the company pays tax.
Exactly. Then the company will be liable for tax on those gains. The exemption applies only to the direct distribution of assets, not to gains arising from the sale of assets by the liquidator.
But what about the shareholders? Do they face any capital gains tax when they receive money or assets from the company during liquidation under Section 46(2)?
Yes, the shareholders are indeed chargeable to capital gains tax. This is a separate event for them. The amount taxed is the market value of assets received on the date of distribution, or the monies received. From this, any portion attributable to the company's accumulated profits, which is treated as deemed dividend under Section 222C and taxable as income from other sources for the shareholder, is deducted to arrive at the full value of consideration for capital gains computation.
To avoid double tax, right?
Exactly. This deduction is key to avoiding double taxation on the same portion of the distribution. Furthermore, if a shareholder later transfers an asset they received on liquidation, its fair market value on the date of distribution will be treated as its cost of acquisition for the shareholder for future capital gains calculations.
Moving on, Section 46A deals with capital gains on the buyback of shares or other securities. If a company, other than a domestic company, buys back its specified securities, which could include employee stock options or other notified securities, how is the consideration received by the holder taxed?
In that scenario, the consideration received by the holder is taxable. The difference between the cost of acquisition and the value of consideration received is chargeable to tax as capital gains in the holder's hands. This is computed under Section 48 and is specifically chargeable in the year in which the securities were purchased by the company.
Now, this next point is a critical distinction that came into effect recently and has major implications for individual investors. For the buyback of shares, whether listed or unlisted, by a domestic company on or after October 1st, 2024, the sum paid by the company for purchasing its own shares is actually treated as a dividend and is taxable under income from other sources for the shareholders. What's more, no deduction for expenses is allowed against this dividend income. So what does this mean for the shareholder from a capital gains perspective?
That's a great question, and it's a significant shift. Consequently, under Section 46A, the value of consideration received by a shareholder on buyback of shares by a domestic company effectively becomes nil for capital gains purposes.
Nil, so it creates a loss.
Yes. This means the difference between the cost of acquisition and this nil consideration will result in a capital loss for the shareholder. This capital loss can then be set off and carried forward according to the Act's provisions, like a long-term loss against long-term gains or a short-term loss against both. This is a powerful shift, turning what used to be a capital gain for shareholders into a dividend taxed under income from other sources for domestic company buybacks.
Beyond individual transactions, we also need to understand how capital gains are treated in significant corporate restructuring events like amalgamations and demergers. The definitions in Section 2 are absolutely key to whether these qualify for certain tax exemptions, which can save companies and shareholders a lot of money.
You're right. For amalgamation, Section 21B defines it broadly as the merger of two or more companies into one, or one company absorbing another. For tax purposes, specific conditions must be met. All property and liabilities of amalgamating companies must become those of the amalgamated company. And critically, shareholders holding at least 75% in value of shares in amalgamating companies, excluding those already held by the amalgamated company itself, must become shareholders of the amalgamated company.
That 75% shareholder continuity rule is key.
Very key, yes. These continuity rules are central to qualifying for tax benefits.
And for a demerger, Section 2, 19AA, describes it as transferring one or more undertakings from a demerged company to a resulting company under a scheme of arrangement. What are the stringent conditions for this to qualify for tax purposes and avoid capital gains?
The conditions are indeed quite stringent, reflecting the government's intent to only grant exemptions for genuine business restructurings. All property and liabilities of the specific undertaking being transferred must become those of the resulting company. Crucially, property and liabilities must be transferred at their book values immediately before the demerger.
Book value transfer.
Yes, though there's an important exception. If Indian accounting standards compliance allows different values, this condition doesn't apply. The resulting company must issue shares to the shareholders of the demerged company on a proportionate basis, unless it's already a shareholder. Shareholders holding at least 75% in value of shares in the demerged company, excluding those held by the resulting company, must become shareholders of the resulting company.
Same 75% rule again.
Yes, continuity is vital. The transfer of the undertaking must be on a going concern basis, meaning the business continues uninterrupted. And finally, the demerger must follow any other conditions notified under Section 72A5. There are also specific explanations for demerger terms. An undertaking includes any part, unit, division, or business activity taken as a whole, but it does not include individual assets or liabilities that don't constitute a complete business activity.
So it has to be a functioning unit.
Correct. Liabilities includes those directly from the undertaking's activities, specific loans used solely for it, and a proportionate share of general borrowings. For property, any change in value due to revaluation is ignored when determining its value in a demerger context, which is important for the book value condition.
No revaluation bump considered.
Exactly. There are also deemed demergers for the splitting or reconstruction of authorities, bodies, local authorities, or public sector companies under specific conditions. The demerged company is simply the company whose undertaking is transferred, and the resulting company is the company receiving the undertaking and issuing shares to the demerged company's shareholders.
Now we arrive at Section 47, transactions not regarded as transfer. This section lists specific transactions that, despite appearing like transfers, are not treated as transfers for capital gains tax purposes. This is absolutely crucial for taxpayers seeking to avoid tax liability in specific, legally recognized scenarios.
Indeed, knowing these exemptions can make a significant difference in tax planning. Let's look at some key ones, often with specific conditions. Section 47(3), gift or will. The transfer of a capital asset by an individual under a gift or will is simply not considered a transfer.
So no tax on gifting.
Correct. For example, if you gift your son a valuable piece of gold, no capital gains tax arises at the time of the gift. The tax implications shift to the recipient when they eventually sell it. Section 47, 40 Megal, holding in subsidiary companies. Transfers of capital assets by a holding company to its 100% owned Indian subsidiary, or vice versa, are not considered transfers. The important condition here: the asset transferred cannot be stock in trade for this exemption to apply. This facilitates corporate restructuring.
Okay, only capital assets, not stock.
Section 47(6), amalgamation. Any transfer by the amalgamating company to the amalgamated company is not considered a transfer, provided the amalgamated company is an Indian company. Section 47 via and VIB, foreign amalgamations, demergers. These cover specific transfers of shares in an Indian company between foreign entities. Conditions usually include that the transfer doesn't attract capital gains tax in the foreign country and rules like shareholder continuity.
More complex cross-border rules.
Yes. Section 47, Vitching and Vitchish, demerger by foreign company. Similar rules apply here for foreign demergers involving Indian shares. Section 47, Vitchish shares, issued by a resulting company. Any transfer or issue of shares by the resulting company to shareholders of the demerged company, if made solely in consideration of the demerger, is also not considered a transfer.
So the share swap is tax neutral.
Generally, yes. Section 47, Vitchish share shareholder transfer in amalgamation. A shareholder transferring shares they hold in an amalgamating company within an amalgamation scheme is also exempt. Section 47 VIDed conversion of gold to electronic gold receipt, EGR, and vice versa. This conversion is explicitly not a transfer, easing the process of digitizing gold holdings.
Useful for gold investors.
Section 47(16) reverse mortgage. Any transfer of a capital asset in a reverse mortgage transaction under a notified scheme is not considered a transfer. For instance, if a senior citizen mortgages their house to receive regular payments, the mortgaging itself is not a taxable event. Tax only applies if the bank later alienates the property.
And the payments are exempt too, right?
Yes, the monthly payments received are also exempt under Section 1043. Section 4071 or ICNA 19, mutual fund consolidations. Transfers by a unit holder in a consolidating scheme of a mutual fund in consideration of units in the consolidated scheme are exempt. This facilitates scheme mergers. Section 4713, succession of firm AOPBOI by company. This is crucial for business restructuring. A firm transferring assets to a succeeding company is not a transfer, but strict conditions apply.
Like all assets liabilities transfer, partners become shareholders.
Exactly. All assets liabilities become companies. All partners become shareholders in the same proportion. Partners receive only shares. Partners hold 50% voting power for 5 years, and demutualization must be SEBI approved. Section 47 GASCOR, conversion of private unlisted public company to LLP. Similarly, conversion to an LLP is not a transfer if conditions are met.
Again, assets liabilities transfer, shareholders become partners, 50% profit share for 5 years.
Yes, and also turnover limits. Company sales turnover receipts, 60 lakh in any of the 3 preceding years, and total asset value of 5 crore in any of the 3 preceding years.
Those are quite restrictive limits.
ER. And crucially, if any condition is not met subsequently, the capital gains not charged earlier become taxable in that year for the LLP or shareholder. It's a clawback.
Let's talk about the Cost Inflation Index, or CII. This is a crucial tool for long-term capital gains, designed to adjust the cost of acquisition for inflation. It's meant to make the tax more equitable.
That's right, by recognizing that money today isn't worth what it was years ago. The CII is notified by the central government and is based on 75% of the average rise in the Consumer Price Index, urban. The formula for the index cost of acquisition is cost of acquisition, CII for the year of transfer. CII for the first year the asset was held by the assessee or R 2001-02, whichever is later.
That base year, 2001-02, is key.
It is. With the CII of 100, it's the starting point for indexation.
While indexation has generally been a significant benefit for long-term capital gains, there are specific assets and brand new rules we need to consider regarding its applicability.
You're touching on a very, very important point. Indexation benefit is not available for depreciable assets, as they are always deemed STCG under Section 50.
Right, we covered that.
Units of specified mutual funds acquired after April 1st, 2023, market-linked debentures, and unlisted bonds debentures transferred and matured on or after July 23, 2024. These are always STCG under Section 50AA.
The ones taxed at normal rates?
Correct. And equity shares, equity-oriented fund units, or business trust units where STT is paid, as these fall under Section 112A with their own tax treatment. Now, for the major game changer brought in by the Finance No. 2 Act 2024, effective from July 23, 2024.
This is the big one.
Yes. No indexation benefit is allowable on long-term capital gains arising from the transfer of NAY capital assets taking place on or after July 23, 2024.
Any capital asset, wow.
It is a sweeping change that affects almost all capital assets and fundamentally alters how long-term capital gains are calculated. The inflation shield is, for the most part, gone. However, there's a specific, very important exception for resident individuals or HUFs transferring land or building or both that were acquired before July 23, 2024 and transferred on or after July 23, 2024.
Okay, what's the exception?
In such specific cases, they have an option to compute tax at the lower of 12.5% on LTCG computed without indexation or 20% on LTCG computed with indexation.
So they get a choice based on what's better for them.
Exactly. But it's crucial to note that this benefit is only for computing tax under Section 112, not for computing income under capital gains for gross total income. For gross total income, indexation benefit is not given in this specific scenario.
That's a subtle but important point for calculation. The source also provides a comprehensive CII table, which is your go-to reference for all calculations when indexation is applicable.
Moving on to Section 49. Ascertainment of cost in specified circumstances. Often, you acquire a capital asset not by direct purchase, but through other means, like inheritance or a gift. Section 49 tells us how to determine the cost in these scenarios.
which is often the cost of the previous owner, right?
Exactly. In numerous situations, the cost of acquisition for the assessee is deemed to be the cost to the previous owner. These include distribution on partition of an HUF, acquisition under a gift or will, acquisition by succession, inheritance, or devolution, distribution on company liquidation, transfer to a trust, transfers between holding and 100% subsidiary companies, transfers in amalgamations or demergers, transfers in cooperative bank reorganizations, relocation of funds, succession of a firm or AOP/DOI by a company, conversion of a company to an LLP, succession of the sole proprietorship by a company, conversion of individual property into HUF property. A significant case law here, CITV Manjula J. Shah, held that for gifted or inherited assets, the index cost of acquisition should be computed with reference to the year the previous owner first held the asset.
Giving a bigger indexation benefit.
Correct. This was a taxpayer-friendly ruling. However, remember the new rule. Indexation benefit is not available for transfers on or after July 23, 2024. So this case law's impact is much reduced now, though important historically, and for the remaining specific exceptions where indexation applies. Now let's look at some specific cost determination rules for other scenarios. Under Section 49, 2AA, for sweat equity shares, cost is the FMV used for perquisite tax. Section 49, 2AA, for LLP rights on company conversion, cost is the cost of the original share. Section 49, 2ABB, for shares from GDR redemption, cost is the market price and redemption request date. Sections 49, 2AD, and 2AF. For units in consolidated mutual funds, cost of the cost of units in the old scheme. Section 49, 2AE. For equity shares from preference share conversion, cost is proportionate cost of preference shares. Sections 49, 2AG and 2AH address units in segregated portfolios. Cost is calculated proportionally based on NAVs before segregation.
For those side pockets.
Yes. Section 49, 2C. For shares in a resulting company from demerger, cost is calculated proportionally based on net book value of assets transferred relative to net worth. Section 49, 6. For reconstituted plots under AP land pooling scheme, if transferred after 2 years, cost is SDV at end of second FY after possession. This links to the Section 1037 exemption, Section 49. For inventory converted to capital asset, cost is FMV on conversion date. And Section 4910, for EGR gold conversions, cost is the cost of the original gold EGR.
Let's delve into Section 55 too. Cost of acquisition. At its most basic, it's the price paid plus expenses. But what about specific assets like goodwill or shares?
Yes, there are crucial distinctions. For intangibles like goodwill, trademark, brand name, if purchased, cost is purchase price. If depreciation was claimed on goodwill before 2020, cost is reduced by that depreciation. For assets acquired via Section 49 modes, gifts, etc., cost is previous owner's purchase price. Now, financial assets like right shares and bonus shares frequently tested. Original shares, cost is amount paid. Rights entitlement renounced, cost is nil. Any money received is capital gain.
So renouncing rights generates immediate gain.
Correct. Rights shares acquired by subscriber, cost is amount paid. Right shares purchased from renouncer, cost is the aggregate of amount paid to renouncer and amount paid to company.
Need to add both parts.
Yes. For bonus shares, generally cost is nil.
Unless allotted before 1.4.2001.
Right. For bonus shares allotted before April 1st, 2001, assessee can opt for FMV on 1.4.2001 as cost. For bonus shares allotted before February 1st, 2018, where STT paid on transfer, cost is higher of. Actual cost, nil post 1.4.2001, FMV 1.4.201 million, a actual sale consideration. This is the grandfathering rule.
The Section 112A grandfathering cost basis.
It's exactly. For equity shares on demutualization, cost is original membership cost. For clearing trading rights from demutualization, cost is nil. For long-term capital assets under Section 112A acquired before February 1st, 2018, the cost is that same grandfathering calculation. Higher of actual cost OR, lower of FMV 31.1.2017 and sale consideration. FMV 31.1.2017 is highest quoted price listed, NAV unlisted units, or a formula, unlisted shares becoming listed.
And what about any other capital asset acquired before April 1st, 2001? Do you get an option for the cost?
Yes, a beneficial option. You can take either actual cost or FMV on 1.4.2001, whichever you opt for. Caveat for land or building, FMV 1.4.2001 cannot exceed SDV on that date if available.
For company liquidation assets, post-Section 46 assessment, cost is FMV on distribution date. If previous owner cost is unascertainable, cost is FMV when previous owner acquired it.
Now on to cost of improvement, Section 55(1). What about goodwill or other intangible assets in this context? For goodwill or any other intangible asset, cost of improvement is nil.
Makes sense.
For other capital assets, cost of improvement is capital expenditure for additions alterations. Crucially, any expenditure incurred before April 1st, 2001 is considered nil. Only improvements after this date count for indexation.
Next, let's turn to computation of capital gains in depreciable assets, sections 50 and 50A. Section 50 has that special rule overriding the STCA definition. Why?
That's crucial. Any capital gain from transferring a depreciable asset, part of a block where depreciation was allowed, is always deemed STCG, regardless of holding period.
A legal fiction.
Yes, created by Section 50. Sections 48-49 are modified accordingly. The logic is, since you got depreciation benefit, any gain is treated as short-term business profit recovery, not long-term appreciation. Let's look at the scenarios. Is sale consideration aggregate of block WDV, started PY, plus new assets cost plus transfer expenses, the excess is STCG, block might still exist. If all assets in block transferred and sale value WDV plus new assets cost, the difference is STCG, block ceases.
Okay, block extinguished.
If all assets transferred and sale value WDV plus new assets cost, the difference is STCL. Block ceases.
Short-term capital loss.
If only some assets transferred and sale value WDV, no capital gain loss. WDV is just reduced by sale consideration. Block continues.
So tax only if sale exceeds block WDV or entire block sold?
Exactly. And under Section 50A, for these assets, WDV is taken as the cost of acquisition.
Section 50AA is another overriding provision affecting specific financial instruments. What does it cover and how are they taxed, especially now?
Section 50AA dictates that gains from transfer, redemption, or maturity of these specific instruments are always deemed STCG and taxed at normal rates. It overrides Section 242A and Section 48, computation indexation.
So no indexation, always short-term.
Correct. This makes them less attractive for long-term holding. The instruments covered are units of a specified mutual fund acquired on or after April 1st, 2023, market-linked debentures, and the recent addition, unlisted bonds or unlisted debentures, transferred, redeemed, matured on or after July 23, 2024. Definitions. Market-linked debenture has returns linked to market indice securities. Specified mutual fund has not more than 35% invested in domestic equity shares based on annual average.
Next, let's explore capital gains in a slump sale. Section 50B. A common way to sell a business unit. What's a slump sale?
Section 242C defines it as transferring one or more undertakings for a lump sum consideration without values assigned to individual assets and liabilities.
Lump sum for the whole unit.
Exactly. Undertaking means a business activity as a whole. Determining value just for stamp duty doesn't count as assigning individual values. Whether gain is LTCG or STCG depends on holding period of the undertaking. 36 months circulates LTCG, FT 6 months is CCG.
Based on the unit's holding period.
Yes. For deemed cost of acquisition improvement, Section 50B2, it's the net worth of the undertaking. Crucial detail, no indexation benefit for slump sales regardless of holding period or transfer date, even post 23.7.2024.
No indexation ever for slump sales.
Correct. The full value of consideration, Section 50B2, is deemed the higher of FMV1 or FMV2 per Rule 11 UAE to prevent undervaluation. FMV1 is asset-based, sum of book values adjusted, market price, Juilliard, FMV share securities, SDV, immovable property, minus eligible liabilities including capital reserves, unascertained contingent liabilities. FMV2 is consideration-based, sum of monetary consideration, FMV of non-monetary, property market price, other non-monetary, SDV, immovable property received.
And both FMVs are determined on the date of slump sale.
Precisely. The valuation date is the sale date. Net worth itself is aggregate value of total assets, value of liabilities. Importantly, revaluation is ignored for net worth calculation.
To prevent artificial inflation of net worth.
Exactly. Aggregate value of total assets for net worth uses. WDV, depreciable assets, nil. Self-generated goodwill, nil. Assets with 100% deduction like 3580, book value, all others.
Moving on to sections 50C, 50CA, and 50D special provisions for full value of consideration. Section 50C for immovable property is key anti-avoidance.
That's right. Under 50C, if actual consideration stamp duty value, SDV, the SDV is taken as full value. However, there's a tolerance. If SDV is up to 110% of actual consideration is accepted.
A 10% buffer.
Yes. Critical detail on dates. If part whole consideration received by account payee check draft SC electronic mode on or before date of agreement, then SDV on date of agreement is used.
Beneficial if values rise.
Correct. Otherwise, SDV on date of transfer is used. Mode and timing matter.
When can the AO refer valuation to a valuation officer under Section 55A related to 50C?
The AO can refer if. Assessee's claimed value, even with valuer report, varies from AO's opinion of FMV. AO believes FMV exceeds claim value by 15% or $25,000.
Quantitative trigger.
Yes. Or if AO deems it necessary due to asset nature circumstances. Outcome. If valuers value SDV, SDV is adopted. If valuers value SDV, valuers value is adopted. If SDV revised on appeal, revised value used. Section 50CA for unquoted shares. If consideration FMV prescribed, FMV is deemed full value. Exemptions for tribunal-approved transfers exist. Section 50D is the catch-all. If consideration not ascertainable, FMV on transfer date is deemed full value.
What happens with forfeited advance money under Section 51, common scenario?
Depends entirely on when it was forfeited. Forfeited before April 1st, 2014, reduces the cost of acquisition of the asset for the seller.
Increasing future gain?
Yes. Forfeited on or after April 1st, 2014. Taxable as income from other sources in year forfeited and not deducted from cost of acquisition.
Taxed separately, cost unaffected. Much simpler.
Much simpler, yes.
Now let's turn to the exemptions of capital gains. Sections providing relief, often encouraging certain actions or easing specific transfers.
First, exemption under Section 10. Section 1033 U.S. 64. Exempts income from transfer of unit scheme 1964 units after 1.4.2002. Section 1037. Compulsory acquisition of urban agricultural land. Important relief for farmers. Exempt for individuals or HUFs if land is urban agricultural. Used for agriculture by individual parent HUF for 2 years immediately preceding transfer.
Proof of agricultural use needed.
Yes, and compensation received on or after 1.4.2004. Also, CBDT Circular 36/2016 clarifies compensation under the RFCTLR Act, 2013 Land Acquisition Act, is generally exempt. Section 1037A, Andhra Pradesh Land Pooling Scheme, exempts gains for individuals HUFs owning land, as on 2.6.2042 and transferred under the scheme. Also exempts sale of LPOCs and reconstituted plots transferred after 2 years from possession.
Beyond Section 10, there are other key exemptions. 54, 54B, 54D, 54AC, 54F, 54G, 54GA. What's the general rule for the capital gains account scheme, CGAS?
CGAS is crucial for flexibility. For sections 54, 54B, 54D, 54F, 54G, 54GA, if you can't invest fully in the new asset before the IPR filing due date, you deposit the unutilized gain of consideration into a CGAS account.
To preserve the exemption temporarily.
Exactly. Amount utilized plus amount deposited is deemed cost of new asset. Deposit must be made before filing ITR or by due date, whichever is earlier. Consequence of non-utilization. If deposit amount isn't used within the stipulated 23 years, the unutilized part is taxed as capital gain in year period expires, except not taxed if assessee dies before utilization. Section 54H extends time for compulsory acquisition. Period starts from date of receipt of compensation. Now the specific exemptions. Section 54, sale of residential house, very popular, eligible, individual and HUF. Conditions, transfer of LTCG, residential house, income chargeable as house property. Investment, purchase one residential house in India, 1 year before 2 years after transfer, or construct within 3 years after. Number of houses in limit. Key recent change. If LTCG 2 crore, only 1 house allowed. If LTCG 2 crore, option for 2 houses. But option usable only once in lifetime.
That once-only rule is critical.
Very critical. CGAS limit. Gain over 10 crore, not considered for deposit. Deemed cost capped at 10 crore. Max exemption, effectively 10 crore.
A hard cap of 10 crore on Section 54 exemption.
Yes. Quantum. If new house costs LTCG, entire LTCG exempt, max 10 CR. If cost LTCG, exempt up to new house cost, max 10 CR. Consequences of transfer within 3 years. If new house sold within 3 years, cost is reduced by previously exempted gain for future CG calculation. Resultant gain is STCG.
Clawback provision.
Yes. Case law on adjacent flats, side Ali Edel, etc. Courts allow adjacent flats as 1 unit for exemption, even if bought separately. Relevant even if LTCG Euro 2CR or 2 house option used once. Receiving share via release deed counts as purchase. New house need not be used for own residence.
Flexible interpretations there.
Section 54B, transfer of agricultural land for agricultural continuity. Eligible, individual and HUF. Conditions. Transfer of urban agricultural land, STCG, LTCG, used for agriculture for 2 years prior. Investment. Purchase another agricultural land, urban or rural, within 2 years. Quantum, lower of capital gains or cost of new land. Case law, Gurnam Singh. Exemption not denied just because new land wasn't used for agriculture for 2 years prior. Purchase is key. Section 54D, compulsory acquisition for industrial undertaking, supports business continuity. Eligible, NESSE. Conditions, transfer of land building rights used for industrial undertaking, STCG, LTCG, compulsorily acquired used for business 2 years prior. Investment, Purchase, construct land building rights for shifting, establishing new undertaking within 3 years. Quantum, lower of capital gains or cost of new asset. Case law, fiberboards. Advance given counts as utilization.
Advance payment is enough commitment.
Section 54 EC, investment in specified bonds. Popular for property gains, eligible. NESSE. Conditions. Transfer of land or building or both, LTCG. Invest in specified bonds, NARICL, etc. Redeemable after 5 years. Time limit. Invest within 6 months from transfer. Strict deadline.
6 months.
Crucial. Restriction. No transfer loan on bonds for 5 years. Note. Conversion to stock and trade. If converted asset sold later, 6-month period runs from sale date of stock. Circular 791. Quantum. Lower of CG or amount invested. Maximum exemption 50 lakh. Hard cap.
Only 50 lakh for 54 EC.
Correct. Case law. Hindustan Unilever. Payment date within 6 months matters, not allotment date. Case law. Ruby Trading. Only for actual transfer, not deemed gains. Section 54F, investment in residential house from other LTCG assets, converting other assets to home. Eligible. Individual HUF. Conditions. Transfer LTCG asset not being a residential house. Investment. Purchase one residential house 1 year before 2 years after, or construct within 3 years after. Restriction. Own max one other house on transfer date. Can't buy construct another besides new one within 13 years.
Prevents multiple house acquisitions using exemption.
Yes. CGA's limit. Net consideration over 10 crore ignored for deposit. Max exemption effectively 10 crore. Quantum. Proportionate exemption. Investment net sale consideration, LTCG. Investment capped at 10 CR for calculation.
So benefit scales with investment proportion.
Exactly. Consequences if new house transferred within 3 years. Exempted gain becomes taxable as LTCG. Case law, Ravinder Kumar Arora, purchase in spouse's name allowed. Case law, Sambandam Uday Kumar, construction investment within periods suffices even if incomplete. Case law, Guli Mahadavalpa. If gain based on SDV 50C, entire reinvestment counts, irrespective of source.
Source of funds for reinvestment doesn't matter. Good to know.
Section 54G, shifting industrial undertaking, urban to non-urban. Encourages decentralization. Eligible. NESSE. Conditions. Transfer machinery plant building land rights from urban area, shifting to non-urban. Utilization. CG, STCG, LTCG, used for new asset shifting expenses in new area, 1 ORI before 3 years after. Quantum. Lower of CG or cost of new assets plus shifting expenses. Consequences if new asset transferred within 3 years. Exempted CG reduces cost of new asset for future gain calc. Section 54GA, shifting industrial undertaking, urban to SEZ. Similar to 54G, but specific to shifting to SEZ. Utilization, quantum, consequences same as 54G.
When does the tax department call in a specialist valuator? Section 55A covers A referring to valuation officer.
It's a safeguard. AO can refer if. Assessee's claimed value, even with report, varies from AO's opinion of FMV for sale or 1.4.201 cost. AO believes FMV exceeds claimed value by 15% or 25,000 rate. What assets, rates, conditions applies to STCG on transfer of US, backward equity share, equity-oriented fund unit, or 3, business trust unit. Rate before July 23, 2024, 15%. On or after July 23, 2024, 20%.
Rate increased recently.
Yes. Conditions. Sale after 1.1.2004, chargeable to STT, IFSC exception. Rate applies even without STT for IFSC transactions. Benefit for residents. Resident individuals' HUFs can reduce 111A STCG by unexhausted basic exemption limit, not for non-residents. No Chapter 6A deduction against 111A gains.
Long-term gains generally get lower rates under Section 112. How do these work, especially now?
Rates depend on asset and transfer date. Applies to general LTCG, not 112A. Transfer before 23.7.2024. Unlisted securities, closely held shares. Non-residents, 10%, no index pay. Others, 20% with index. Listed securities, not 112A CVBs. Lower of 10%, no index, or 20% with index. Other assets, not 112A Tanner, 20% with index. Transfer on or after 23.7.200 for big changes due to indexation removal. Land building acquired before 23.7.2024. Resident individual HUF. Option for lower of 12.5%, no index, or 20% with index.
The special option for residents.
Yes. Other assessees, 12.5%, no index. Land building acquired on after 23.7.2024, or other assets, not 112A, 12.5% no index. Non-residents unlisted shares, also 12.5% no index vex.
So 12.5% without indexation is the new normal for many LTCG assets.
Broadly, yes. Important points. Residents basic exemption can reduce 112 LTCG by unexhausted basic exemption. Debentures bonds. If unlisted transfer deemed matured on after 23.7.2024, always STCG 50AA. No indexation benefit ever for bonds to debentures.
No indexation for bonds all.
Correct. Non-residents, listed shares, debentures. Tax at 20%, 12.5% without indexation, but with foreign currency fluctuation adjustments. No Chapter V8 deduction against $1,025,000 from weight.
Section 112A has its own regime for listed shares, etc. What's the rate and threshold?
That 1.25 lakh exemption is key.
Yes. Rate on excess over $1,025,000 before 23.7.2024, 10%. On or after 23.7.2024, 12.5%. Total exemption across all such assets capped at $1,025,000 per year. Conditions. Equity share. STT paid on acquisition and transfer. Exceptions for STT on acquisition exist. Example, pre-October 2004 share Section 47 transfers. Unit of equity-oriented fund business trust. STT paid only on transfer.
Easier condition for funds trusts.
Yes. IFSC exception. Rate applies even without STT residence base exemption. Can reduce 112A LTCG over $1,025,000 with unexhausted basic exemption. Not for non-residents AOPBOI. No Chapter VIC made deduction. No Section 87A rebate against 112A tax.
No rebate against this tax.
Correct. CBDT clarifications confirm. Holding period 12 months. Business trust units 12 months from 23.7.2024 was 36 months before. No tax on gains accrued up to Jan 31 to 2018 grandfathering. LTCG loss allowed set off carry forward.
One of the most common questions are profits from selling shares, capital gains, or business income. Huge tax impact.
It is, and historically fact-specific, leading to uncertainty. CBDT Circular 06206-62 brought clarity for listed share securities. Assessee opts for stock and trade. If assessee chooses this, income is business income. Provide certainty. Listed shares held 12 months. If held 12 months and assessee desires it treated as capital gain, AO shall not dispute it.
Presumptive rule, very helpful.
Yes, but condition. Stands taken once must remain same in future years. No switching back and forth. Other cases. Unlisted shares, or listed held 12 months not treated as stock, decided based on older principles. Frequency, magnitude, funds used, etc.
And these principles don't apply to sham transactions, obviously.
Absolutely correct.
Yeah.
The aim is reducing litigation for genuine cases. All other Act provisions still apply.
Beyond sections, court rulings shape practical application. Let's quickly recap some key case laws.
These provide critical interpretations. Compulsory acquisition. Higher compensation later doesn't make it voluntary. Section 1037 exemption can still apply. Depreciable asset in 54 EC, vs. Dempo. Section 50 fiction, STCG, doesn't deny 54 EC exemption. 54 EC applies regardless of asset type. Advance payment and exemption, fiberboards. Advance given counts as utilization for 54G, 54D. Adjacent flats, site alia deal, etc. Treated as one unit for Section 54, even if bought separately.
Practical view from courts.
New agri-land use. I'm saying 54B not denied just because new land not used immediately for agriculture. New house and wife's name, Mirabali, Ravinder Aurora. Allowed for 54F, construction incomplete, Sam Banabude Kumar. 54F allowed if investment made within time, even if not fully complete. SDV for reinvestment, Guli Mahadavampa. If gain based on 50C, entire reinvestment counts for 54F, irrespective of source.
Source of funds doesn't matter for reinvestment claim.
Bonds allotted late, Hindustan Unilever. 54 EC allowed if payment within 6 months, even if allotment delayed. Payment date is key.
Wow, that was a truly comprehensive deep dive into capital gains. We've unpacked everything from the foundational definitions to the intricate calculations, crucial exemptions, and those real-world scenarios that often pop up in application-based questions, especially with those brand new changes impacting indexation.
You now have a detailed roadmap, understanding not just the what, but also the why behind these complex tax provisions. This detailed understanding prepares you not just for exams, but for making informed financial decisions in your own life. You're now better equipped to understand the nuances of asset classification, transfer implications, and strategic investment choices.
Considering how profoundly these capital gains rules shape everything from your investment decisions and business restructuring plans to even how you pass on an inheritance, what do you think is the biggest surprise or the most impactful rule that you've learned today that might change how you view financial planning going forward? Join us next time on The Deep Dive, where we continue to transform complex information into clear, actionable knowledge just for you.